Risk is not about losing money. Be very clear about that. If you lose money, there's no risk in that. If you were expected to lose money and you made money, well, what do you mean? Why did you make money? You said you were going to lose money. So the point is, risk is surprise. Risk is uncertainty. You didn't do what you said you were going to do. Risk is standard deviation. There's a range of outcomes. So in finance, this represents a distribution of potential outcomes. Now, it doesn't always have to look like a bell curve, but that's the idea. As we think about a project, we think about a company, and we think about how certain are we about what's going to happen? What is that range of outcomes of what could happen here? What could that look like? That distribution of potential outcomes equals the risk. And mathematically, how wide that distribution is the standard deviation. And that basically is what we use in finance for risk. So it's what are your standard deviations and how many can there be? And what does a curve look like? Second thing we look at is the concept of risk premium. And this is an oversimplified view of a Nobel winning economics prize. And so this is 90 years worth of data from 1928 to 2018, year by year distribution of three things. The S&P 500 index, which is 500 largest companies in the US. These are 10-year US government treasuries and 3-month US government treasuries. The point about the S&P 500 is if you bought the S&P 500 index, I own 500 US companies, over 90 years, this 90-year time horizon, some years you lost 30 to 40%, some years you made 30 to 4%. Generally, you made more than you lost, but you had a lot of variation. In fact, in August 2020, you made 30% in 1 month alone. So the market was all over the place. It zigged, it zagged. But over time, you did okay. If you invested in government 3-month treasury bills during this 90-year period of time, you never lost money and you always made a little bit. So the distribution of this return was skewed to the right and it was never negative. Whereas the distribution of stocks was skewed a little to the right, but it was very much looked more like a bell curve. And so here's the point. The way that we started to think about risk in finance is we looked at these distribution, we said, aha, more uncertainty, more distribution for the S&P 500 than treasury bills, more risk. So risk is uncertainty, more risk. Number two, for this uncertainty, I should get paid for that, risk premium. The more uncertainty, the more cost of money, cost of capital, higher hurdle rates. And so we started to look at risk premiums. And so those are really the two things that drive the cost of capital.